I'm all about risk reduction. So I think the best way to make money in real estate is not to lose money. Kind of the Warren Buffett rule. So I shoot on every deal looking at it from the standpoint of like, let's not lose money. How can I make sure investors don't lose money on these deals?
Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. I've got another amazing guest with me here today. I've got David Priest. David, welcome to the show.
Thank you. It's great to be here. Good morning.
Yeah, absolutely. Looking forward to chopping it up with you. And for our listeners, Dave and I are really kind of cut from a fairly similar cloth. We both have experience, really for a couple of decades, in the real estate space. David also did over $500 million in mortgages, as a solo operator, in the real estate space. He's been a broker for the last 15 years, transitioned into multifamily. And now in 2023, he almost exclusively raises capital for private equity syndication deals that he's going to be basically investing his own money into as well. And that story, David, for my listening audience that knows me, sounds like super similar, to my own, personal and professional story. So would love for you to maybe kind of help, us unpack that a little bit more, talk about maybe kind of your journey, into the space, what you're focused on today, et cetera.
Yeah, probably the most interesting thing is as I was in the business for the 20 years doing mortgages, doing real estate brokerage. I never bought any single family properties as investments. I was just doing transactional because I was terrified of managing properties. I didn't want to collect rent. I was scared of all that. So I was worried about getting into these management issues and having to, basically work with people, doing evictions or something terrible like that. I was scared of managing. So I didn't buy anything, and I got into syndications mainly after the COVID, when the stock market had dipped. And I told my wife, we've got to get into some real estate. I didn't know anything about syndications. The first person that told me about it was a guy with a New York accent. He was from Brooklyn. And I thought he was like in the mafia when he started talking about syndications. I had no idea what he was even talking about. So what I learned was that you can be an expert in single family, be a real estate broker, be a mortgage broker, no single family upside down. But when you get into multifamily or any kind of commercial real estate, you're really operating in a different universe and you have to relearn everything. And you've just got to start from scratch and realize you don't know this world and you've got to relearn it. So that's what got me originally into it. Originally, I was just going to be a passive, and I started hanging out with operators and hanging out with people in the business. And I just loved the business. And I kind of felt like this is what I want to do for the rest of my life. And I kind of found my purpose. So I think it's great people that find that earlier in life, but I was in my 50s and decided, hey, this is what I want to do. And this is what I'm supposed to be here for. And that's what I do now. So I love it.
Yeah, that's great. I'm glad that you found your, kind of purpose and your why and your, you enjoy, what you're doing, day in and day out, really kind of looking back, as, a solo operator with $500 million, in mortgages, what are the maybe 2 to 3 different, underwriting red flags that you would say most investors still overlook, and maybe how can they spot or identify them early?
Right. Well, I'm all about risk reduction. So I think the best way to make money in real estate is not to lose money, kind of the Warren Buffett rule. So I shoot on every deal looking at it from the standpoint of like, let's not lose money. How can I make sure investors don't lose money on these deals? So I look at the experience of the team. I like, 8 to 10 years in the business, full cycle exits. It doesn't mean that everything has gone perfect. When people have large portfolios, been doing it a long time, and they tell you every deal's gone great and they're not in trouble in anything and nothing ever bad has happened, that's a runaway. That's a huge red flag. So I look for people with a lot of experience. I only do fixed rate debt. So I'm really big on fixed rate debt just to make the deal safer. And I want deals that cash flow day one. So if it's not cash flow for me day one, it's a no go. I want immediate cash flow, and then I want the ability to add value and then increase that cash flow in the future. But I don't see real estate as a home run business. I see it as you're going to do probably 15 to 20% on these deals. If the market is better, or if you exit early, or if everything just kind of clicks, you might do 30%. But those are not the returns to shoot for. And so much of it is dependent on interest rates and whatever market you're buying or selling into.
Yeah, it makes total sense, and I wholeheartedly agree with you. You know, I've had some deals that I've personally invested into, you know, over the last decade that have been absolute grand slams, you know, but I've also had a couple that I've, you know, struck out on largely. So I'm at a position now in my life where I'm predominantly looking for, you know, those singles and doubles. And if somebody's projecting a grand slam or a home run deal, you know, then I'm going to be sitting on the sidelines because I know I'm paying a risk premium, you know, for that type of an investment. So I know, David, that you talk a lot about, you know, kind of your what you call your risk stack. And I know that there's some primary things that you've already identified, you know, like the sponsor, the debt, you know, on the investment. But, you know, outside of, you know, maybe even the sponsor, the debt, you know, are there other types of, you know, items in your risk stack that you look to mitigate, you know, things like the business plan, you know, where we're at in the market cycle, you know, the execution risk, the operations risk, those types of things?
Yeah, I look at a lot at the location and the market right off the bat. So when I'm looking at a deal, before I even look at numbers, I'll look at the debt structure to see if that's a yes or a no go. Then I'll look at the experience of the team, and do I like the team? Somebody I want to invest with myself, because I'm putting money into every deal myself. And then I look at the location in the market. What's the population growth? What's the job market? Is this a great market? Is population going up? Is the state friendly to landlords, or is it friendly to tenants? I want one that's friendly to landlords. So I look at those kind of factors. And so I look at all that before I even look at the numbers. And what I found is the most experienced, most seasoned operators will have the most conservative numbers in their deck. And the people that are newer or less experienced tend to have returns that are outsized. So I look at the numbers last, but if the numbers look too good to me, that's a red flag. So I'm looking for stuff that's a little bit more conservative. And I think if people are shooting for the stars, you've got a chance of it not going as well as you think. So that can be a huge problem.
Yeah, no, I appreciate that. And you kind of identified a couple of things, you know, one being, you know, landlord friendly states. I'd like for you to maybe explain that in layman's terms, you know, to our listening audience. And then secondly, you talked a little bit about, you know, what we call conservative underwriting, or I like to use the word realistic, you know, because everybody says that their underwriting is conservative, but clearly there's some differentiators in there between what conservative really means in actual practice and in real life, right? And so I think I'm hearing you say that operators that are overly aggressive, you know, in their assumptions or are weaker in their conservative, you know, underwriting principles, more than often that's because they have a hard time raising the capital, raising the equity for their deals. So they need to throttle up or throttle down, you know, a few numbers, you know, or governors in the underwriting model to make the deal look more attractive so they can raise the money. Am I saying that correctly?
That's exactly right. So, what they will do is juice up the numbers, and unfortunately, inexperienced investors will be attracted to these higher returns. So, I mean, I've been on the phone with people where I've got a deal that's like an 18, 19 IRR. It's a really good deal. It's a really safe deal. And people are like, I just don't like it. I wish the returns were better. And so I always ask them, well, if you can look at this business plan and you can find a way for us to take a lot more risk and make more money, let me know, because right now that's not what where I'm shooting for or what we're looking for. So the more experienced people tend to know that they're going to have problems, and they want to basically under promise and over deliver. When people have too much confidence and they're the master of the universe and they lack humility, they're probably going to get in trouble at some point. So I believe this business has a real humility factor to it. And so if you don't have humility, the business will hand you humility. And that's happened to a lot of people the last few years that didn't have the proper humility. So you have to always go in with confidence. We can do this. We have a great team. But in the back of your mind, there's a little bit of humility to you. And the best operators know there's going to be trouble, and they have reserves, and they don't think that everything's going to go perfect. and that humility will keep your money safe.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
We've really been talking a lot about, really, your, due diligence checklist, when you choose to partner with an operator. And as we've, said once before, and we'll continue to say again, as a passive limited partner investor, you're investing in the jockey, not necessarily in the horse. Although we could argue that to be, both ways really. But, I'd like for you to maybe unpack a little bit more about, your due diligence checklist. And there's two things that I, really like to hone in on. One is, obviously their vertical integration where they can control, all aspects of the investment timeline from acquisition all the way through disposition. And what does that vertical integration actually mean, in principle? And then the second component that I think oftentimes investors tend to overlook is the leadership quality of the principals, right? Their ability to create a positive work culture, right? Their ability to attract best in class talent, their ability to cast a vision, right? All those things are incredibly important, that I think oftentimes, passive investors, miss out on those diligence items.
Mistake of thinking when they invest in a real estate syndication, let's say in an apartment building, that they're investing in real estate. You're really not. You're investing in a business. So you want the CEO, the CFO, the team, everything to be amazing people. So you're trying to buy into an Apple or a Walmart or an amazing business. And so you want to see when people have that vertical integration, what kind of team do they have? Do they have a team that's large enough? One red flag I look for is sometimes you'll have a team where you really have one person that's kind of really in charge of everything, and because of maybe their lack of humility, they don't have a lot of really strong people on the team. Everyone seems to be kind of a B class person on the team below them. So I look for people, teams that everyone on the team is really amazing. And then, God forbid, something happened to somebody during the deal, a health issue, they can't perform. Do the other people on the team have the ability to step up and help get the deal to the finish line? And also, those team members have equity, so they're really involved in the deal. Some leaders like to grab all the equity and then everybody on the team is an employee. And at the top levels, that doesn't work very well. But when you have a great culture and a great business, it's definitely going to help the deal to get to the finish line if you're dealing with a vertically integrated business. And it's very difficult to build those kind of teams, and not everybody can.
Yeah, it makes total sense. I'd like to tell you about a call that I recently was on with a potential passive limited partner investor. The investor basically said, "Listen, I want to invest in your next investment opportunity. I don't care about the returns. I don't really care necessarily about the business plan. I just want to diversify outside of Wall Street and into Main Street. And I really want to lock in 2025 tax year depreciation." I'd like to get your take on something, and that is I'm starting to see a trend emerge with higher net worth individuals where they're seeking after diversification from Wall Street, and they're also seeking after tax depreciation benefits. But the challenge with that line of thinking is we can choose to go after diversification, we can go after tax benefits, but what if you're deploying $100,000 of your hard-earned money into a bad deal? Are you starting to see some of those trends emerge yourself?
Yeah, I mean, I had someone I had a deal earlier this year that had really really good depreciation after the big beautiful deal because it was a higher leverage deal, and then I did one that was lower leverage. I had one person invest in it, and then they told me, well, this one the depreciation doesn't look near as good, and they didn't like the deal as much just based on that one factor. So I'm seeing more of that, but it is a little worrisome that people are looking more at depreciation or looking at the tax benefits than the actual deal itself. I got some good advice one time. I was on a podcast with Justin Donald. I was watching his podcast, and he said, never, ever, ever invest in a deal based just strictly on tax benefits. I mean, if you want the best tax minutes, you could lose money and it gives you a great write-off, but that's not a good reason to invest. So that is a factor. And basically, the new law has handed us a lot of tools to reduce the taxes as much as possible, but you should still look at the upside. So, I mean, I look at all three like, okay, do we get good tax benefits on real estate? Fantastic. Do we have a great return? Maybe 15 to 20%. And then with this operator, if there's an early exit or if the market's better than we think, is there still upside? And you have a lot of people that have given up on upside. Like debt funds are hugely popular right now because people are like, oh, I just want my 9%. Okay, so let's look at that. You get your 9, and then it's taxable. There's almost no way to offset it. You're down to 6, and then there's inflation. You're down to 3, and that's if you believe the inflation is really 3%. So really, you want to take no risk and get 3%. And to me, it's not acceptable. It's just you're kind of giving up. And the time to do debt funds was back in 2022 or 23 when the market was blowing up and saving your money for these deals. But now, when you can buy low and blood's in the street, for lack of a better word, this is time to go all in on good deals if you can find them.
Yeah, absolutely. I couldn't agree with you more. And, hindsight, obviously, right? But I think, for me personally, the best approach has really been that, of a diversified approach. If I've got some dry powder sitting on the sidelines, I have no problem sticking my dry powder, in a debt fund, really to, continue to leverage, some, cash on cash return, understanding that there's no equity upside, there's no tax benefits associated with that investment, but at least it's earning something better, than the 2.5 to 3.5%, that I can earn in a money market account. And I like debt funds, obviously, that have a short, lockup period as well. So I can liquidate, my investment, relatively easily and on demand, so that I can, further deploy that capital, into the next, real estate deal that I'm willing to put my own personal cash into. So I know, everybody, we kind of talked about this before, David. We talked about this kind of topic of conservative underwriting. Are there any specific, assumptions, whether that's rent growth, exit cap, vacancy, interest expense, are there any specific assumptions that really help, kind of the non-sophisticated, maybe high net worth investor really to expose things in the underwriting model that the average person just overlooks?
Two things, which would be rent growth and exit cap. And I think one of the biggest mistakes people make is they'll have an offering where they say, hey, the rents are 10 to 15% below market. And then they underwrite that they can raise the rents 10 or 15% in 1 year to get them back up to market. And then they're going to go 3% from there on out. That is impossible, I think, in the current market right now, especially if you're looking at a B or C class property. It takes time to raise rents, and it's got to be done very gradually. And if you raise 10% rents the first year, your occupancy is going to drop 10%. So if you raise them 10, your actually drops 10. You didn't raise them at all. So it's very difficult to do those immediate rate bumps, especially in markets where people are already stretched out on, like, say, workforce housing by inflation. They just won't take it. They'll move into another apartment complex that's not raising the rents or isn't as nicely renovated. On exit caps, everyone is assuming now that the market is going to get better 3 years from now than it is. And I think that's a great assumption. But I would still take the current market cap and add about 10 basis points per year for your exit cap and see what that looks like and see if the deal still pencils out. Will the cap rates probably be lower, interest rates being lower? I think so, definitely. But you should stress test it both ways. Can they still survive if they're actually higher than they are now?
Yeah, makes sense. One thing we didn't really talk about was, market selection. Are there any particular data points, whether that be, new supply, projected, pipeline, job growth by maybe specific sector, absorption, affordability ratios? What are maybe some of those most reliable, predicted, risk-adjusted performance metrics that you look at when evaluating a specific market location?
Think you should definitely look at population growth and job growth, and then you can look at supply. But I don't know of any markets right now going out like to 27 or 28 that have a ton of deliveries that are going to come. So if you've got the population coming in, you're probably going to be fine. So I'll use Houston as an example where I live. I think right now the delivery schedule for 27 that are permitted are like something like 1,400 units or something that's ridiculously low. Like I'm a general partner in almost 1,400 units right now. I mean, it's nothing. So we got that kind of population growth and job growth in a place like Houston. You're going to have a shortage, and everything being built now is really kind of what I call like super A class. The Ritz Carlton type apartments that are super nice, and so older apartment complexes are things that are the rents are lower. Nothing can be built at this point that will compete with those. So those kind of investments are really, really good values because you can't build anything like that anymore at any kind of cost. And what's slowing down development, obviously, is tariffs. People don't know what construction costs are going to be. There is fear in the market right now. So a lot of people are afraid of developing, or the interest rates are still too high and they haven't come down yet. And then you've got labor issues. If you're in like where I'm at in the Sun Belt, I mean, we have a lot of labor force that comes from other countries. And right now, with a lot of ICE raids and things, it's hard to get people together as a construction team or a crew, and it's harder to put that together. So that's affecting development also, or construction projects. It's another reason why I like deals that don't have a real heavy construction part of the value add. I like stuff where the management is poor, the operator's in trouble, the debt is the wrong type of debt, and they're in trouble. And you can buy a really, really clean property with 90% occupancy for a 35% discount. That's like the low hanging fruit. I do think those other type of value adds will be great in the future when the market recovers and when basically prices are up. But right now, why get into a more complicated deal than you have to when there's these really easy deals out there that are they just look great.
Yeah, makes sense. And I'd like to get your feedback on where you think we're at in the current market cycle, understanding that you don't have a crystal ball, nor do I either. But it's pretty clear that we hit the peak of the latest cycle back in 21 and 22, and we've really, regressed, since then, depending upon, the market location and the asset class. We're down anywhere from 30 to even upwards of 40%, lower valuation wise from where we were at the peak of the last, real estate market cycle, especially in, kind of that workforce housing, B class, demographic. So, right now we're in Q4 of 2025. How much additional time do you believe is left, in the market cycle where we can continue, as investors to aggressively attack the market, at largely a lower price point than maybe what we were able to just 36 months ago?
Yeah, I mean, well, I think one thing that's a little bit encouraging is obviously prices came way down, but it seems like in the last, like, say, 12 months, I would say 2025, they feel like they bottomed out. You're not seeing stuff go any really lower. It seems like it's hit a point where it's a trough at the bottom. Now, we haven't seen prices come up yet, but as interest rates go down, the prices should go up. And I don't have a crystal ball, but you should see that come up. And obviously, there's a lag effect. It's the same thing when the Federal Reserve lowers rates, there's a lag effect in the economy. There's probably a 9 to 12 month lag effect. So I'm a little bit of a contrarian here. Everyone wants the market to get better. But since I'm buying properties right now and I don't have to sell anything and I'm newer in the business, if this strings out a little longer and the prices stay low another year, it wouldn't bother me at all. However, I think eventually the lower rates are going to catch up, deals start penciling, more buyers come in, and people see the prices per door or cap rates or however you want to measure it start to go up, then people really pile back in. And then when it seems like it's taking off, then the big money institutions really pile in. And then it's rocket fuel that really blows the market up again. And then multifamily's back. But then everyone that waited for multifamily to be back, they missed all the great opportunities when it was not back. So the lower interest rates will save the market if rates go.
Yeah, I'm kind of licking my chops over here because you're stating the exact same strategy that I have as well. Fortunately, I'm in a position where I don't need to exit out of any deals that I'm in right now, right? In fact, I don't want the operators to sell the deals because I don't want to give the next buyer a potential discount, in a down market. But I, as an individual contributor, and an investor in the space, have made more investments in the last 36 months than I did the 36 months prior to that. Because I remember what happened, as a real estate, owner in the single family space, when we were wholesaling and fixing and flipping houses, buying properties at a discount is a great time to get involved. And we all know when it comes to real estate, for the most part, real estate always tends to go up and to the right over time. Time tends to heal, a lot of wounds. But as individual investors and contributors in this space, we need to understand that there are cycles, and we are absolutely in a cycle right now. Whether we're at the bottom, we've hit the bottom, we're on the upstroke is really anybody's guess at this point. But what we do know is we are certainly able to get into institutional grade quality assets at a much better basis today than we were able to invest into just 3 years ago. Does that make sense?
Yeah, that makes total sense to me. And also, coming out of the financial crisis, I got married in 2008. So my wife and I had two incomes, and we decided we're going to live off her W-2, and we're going to invest all my money that I was making on my businesses. So I was putting a lot of money in the stock market when the Dow was like 6,500, and everyone told I was crazy. And so I did really well with that, obviously. So when people say something is crashed, like it's crashed or it's crashing, that's when I get really interested in that market. So right now, the only thing I'm aware of besides office that's cheaper in the whole world than it was 3 years ago is multifamily. Somebody told me big screen TVs, but I don't watch television. I can't invest in them. But other than that, it's multifamily. Office, I'm not, I mean, some people will make a lot of money in office. I don't know who these people are. I'm just not, that market's way too hard to even think about. But multifamily is something I know people have to live somewhere. It's not going to be replaced by AI. And I know it's a lot less expensive now than it was 3 years ago, and nothing else is. So I feel really confident that it's going to do really, really well in the next, like, say, 3 to 5 years. And at some point, it may settle out, and we'll see how far it goes and how enthusiastic people get again. It may take some time, but now's the time. If you have money to place, I think it's probably the second best time in our lifetimes, except for the financial crisis, obviously. But I talked to people that were going back in 2010. I was at a conference, and there was a guy from Florida, and he was saying that they were buying stuff in 9 and 10, just like it was crazy. And I think he was in one of the Tampa market, I think in Florida. And I said, well, what happened? He said, well, in 2015, we stopped buying properties because they had become like an 8 cap, and we thought the deals were bad, and we just quit. So it just shows you, the relative difference in the way that the markets are. And right now, I think it's a great time to be in this business, and I'm very excited about the future. Not saying we don't have another leg down or more problems, but if you have capital and you have great operators, the problems provide more opportunities. So it's a great time.
Yeah, well, I couldn't agree with you more. And David, I feel like we could continue this conversation for the next several hours, but I like to keep these episodes to under 30 minutes in length. So I just wanted to, first of all, thank you very much for the tremendous value that you've brought our listeners today. And then second to that, I'd love for you to let us know a little bit more about, how maybe we can connect with you to learn more about what you're up to offline.
Sure. The best way to connect with me is on LinkedIn. So you can go on LinkedIn, you can see what I'm up to, and you can book an appointment with me to talk to me right there. Most of the deals I have, I put on LinkedIn or Facebook if they're 506C. 506B, I can't do that. So if you want to see some of the private deals I do, you have to get in touch with me. We need to establish a relationship. I also have a lot of education I do for passive investors, and that's on YouTube, on my YouTube channel. It's the same as my name, David R. Priest, Priest. And I got a 5-hour masterclass that's on YouTube for free. So if you want to see how I look at deals as an LP, or how I decide what deals I'm going to participate in, all my good information's on there.
Yeah, that sounds good. And we'll definitely put those links in the show notes for the episode. Again, David, really appreciate the tremendous value you've brought us. Yes, and listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.